Hi everyone, welcome back to the podcast. For a change, we thought we'd break out of the dreary grey and throw some color on the back and maybe keep this going for this year for our Be Rich and podcasts. I don't know. We'll see. Anyway, Keshav.
So today I have come up with some fundamental terms, sir, that we discussed in Learn to Earn, sir. Because as you said, Learn to Earn, when we did fundamental things like briefing a fundamental term in stock market, it gives nice input for viewers to watch, sir. So much of us, I saw after you said you saw the comments, then I went and saw. Most of us said that's best video for beginners or something like that. So I thought you will also give some thing to our Be Rich viewers, sir. So today we are going to talk about 4 things, which is P ratio, face value, book value, and ROE, sir. And I'm going to add up some comments from yesterday's money page video, sir. Learn to Earn video, which they had some doubt on something we did here. So first of all, we are going to talk about PE ratio, which is price per share by earnings per share. Price means the share price, which the share is trading right now. Is the share of the price is known as price per share. Earnings per share means how much the share earned for us, like profit. Earnings of the share means the profit of the share. Let me give you a good example, like as sir already mentioned so many times, like Keshav medical store, you can get connected with that. So if I want to open a medical store, which is going to cost me around 15,000, I am having 1,000 rupees. Now I have to find 14 peoples who need who are ready to give me 1,000 rupees. So that comes up with a sum of 15,000. So after that, I'm opening a medical shop and it is running good. So after some time, I'm getting a profit of around 7,500, leaving my tax and everything. After that, I'm getting 7,500. Now I have to pay them. So what I have to do is 7,500 for 15 peoples means that goes 500 rupees for each. So the share which earned me 500 rupees per share, it earned 500 rupees. It's the earning per share. If you want to calculate the earnings per share, you have to use this formula, like net income by number of shares. By calculating this, you can get the earnings per share. But I tried this, it came difference, but I don't know which is a good formula. Most of us use this formula. So why we have to see the PE ratio means because when we have to see the company's future growth, we have to see the PE. As on yesterday's money page video, I thought by seeing the PE, we can put it in the watch list, but it is not as, if you have seen the money page video, sir said that PE is something that you have to look, that's it. For the company's growth purpose and all. That doesn't mean you have to consider and all, and you have to put that in the watch list. So PE is almost an important thing to watch, that's it. And the next thing that most people make mistakes on seeing the PE ratio is, they compare different sector stocks with each, seeing the PE. That doesn't work at all, because you have to consider the stock which is in the same sector. Like if you take TCS, you have to you have to compare it with Infosys, not with ITC and all. So it doesn't make any sense. So the most of the people are making mistakes in that. I'm also made some mistakes on that. So I'm telling this. Is this correct, sir? PE.
Correct. But remember,
Yes, sir.
like we discussed in that video, earnings per share, there are many different forms of earnings per share.
Yes, sir. You said.
So don't focus on earnings per share, taking it from the internet and trying to find out the PE like that.
Okay.
Instead of that, you know the PE, you know the price. By dividing the price per share by PE, you will give the earnings. So if you want to calculate earnings, you'll be better off like that.
Okay, sir.
Calculating in reverse, since we are beginners.
Yes, sir.
Okay.
Sir, and I have a question on that, sir. One guy asked a question like...
So what Maniguna is asking is PE calculation, the stock price. Yeah, so what he's saying is PE is price divided by earnings per share is PE. But he says EPS is last financial years and stock price is current. So he says you're getting the wrong PE because EPS is last year's EPS. How do you get the current EPS?
Yes.
Current EPS, this is what I'm saying. As a beginner, we're a value investor.
Correct, sir.
Okay, we're looking at long-term investing. Earnings, yes. If you really want to nitpick, you can get into quarterly earnings. You'll get EPS.
Correct, sir.
So then you add the quarterly EPSs together, you'll get trailing 1 year EPS, which you can take and calculate the PE. Most of these websites like Screener and all that do that for you.
Oh, okay, sir.
Okay, they take trailing EPS quarterly, they add it up, and they put it together, and they give you the EPA, take the earnings, and then they divide by current price. So it's pretty close to what the EPA PE is right now.
Okay, sir.
Okay, but you don't need to get into it too detailed, right?
Understood.
If there's a price movement, that's what creates most of the fluctuation in the PE.
Correct, sir.
Right. Earnings also, yes. That's why if you see Anand's old videos, he'll keep saying Nifty should correct to 10,000, will come to 12,000.
Okay.
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 A lot of people have seen the old videos will say, what was Anand sir saying? It never came to 10,000, 12,000. It's gone now all the way to 21,000.
Yes, sir.
We are sitting and waiting for 10,000. That's because the earnings is also picked up.
Correct, sir.
There's two components to the PE. The Indian stock market PE is also there, the Nifty PE.
Okay.
Okay, which is what we've done many videos on that, where we've shown the heat map of the Indian stock market over a period of 15 years, 20 years, and shown how average PE in the Indian stock market is. And when you see the stock market, it is moving from the medium, which is around 20, it's going very high towards 30, or go up to 30 and it's coming down to 26, but it's never come down to the baseline of 20
Understood.
for a very long time. So that gap is what Anand is always talking about. That the market is overvalued. Historically speaking, the Indian market has an average of 20 PE, let's say. So it has been above that for a very long time. And people will say, because people like you have not seen it go below that, will assume it never goes below that.
Yes, sir.
Like a lot of people saying, why can't we buy diamond needles? Right? The reason is, if you see the history of Indian stock market, there have been times when it's gone below 20 and it stayed there for a long period of time. Like what Albin also spoke about, time
Yes, sir.
in the market. That you can be in a bad market for a long time.
Yes, sir.
You know, a market correction can last for a long time.
Correct.
And most people, like your generation, have not experienced this.
Yes, sir.
So
We
I do
didn't
not
see any
know.
market
So when you say Indian PE market PE historically is at 20, if that is the average, and you've only seen the top half, and in mathematics, average means it's up and bottom, top and bottom, you're taking an average of.
Yes, sir.
So I've not experienced a bottom bit as yet.
Yes, sir.
So that's what it means. Coming to his thing, you can calculate, right?
Okay, sir.
Every quarter-wise, companies give results. Like Asian Paints give results, Reliance give results, Hindustan give results. Each company gives quarter-wise, and in that there'll be earnings per share. They would come. The board will declare this is the earnings per share. So you can take quarter-wise, add it all to up. If you want to do so much of research, you can. Take the company's published literature itself, and that earnings are there. You add it up, and then you will have the EPS
For a year.
Yeah, for trailing year, because they are not finished for full financial year. So you're taking 4 quarters. So then you take that together and you can calculate.
Okay, sir. Done, sir.
Remember, earnings per share you should take for a full year,
Yes, sir.
not one
A single
quarter.
quarter.
Yeah, single quarter. Then it will become a problem. Sometimes what other people will do is they'll take the recent quarter and just assume it's going to be near that for the next 4 quarters, coming quarters, forward. So just multiply that by 4. So let's say this quarter you have 1 rupee or 4 rupee or 10 rupees, 5 rupee. You just multiply it by 4. So you get for the entire year.
Understood, sir.